Gold is trying to tell you something, and you don't need a set of ears like my man here in order to hear what gold and silver prices are trying to tell you. At the same time, it may be hard for you to hear it and believe it because the last 3 years of price consolidation, they've been a little bit rough. I know it's really easy for us gold and silver investors to feel like Charlie Brown with the market being Lucy. You know how Lucy always promised to let Charlie kick the football, only to pull the ball away at the last second, only to watch him go flying through the air? Yeah, that's what the last 3 years have felt like for sure. While it's easy to say this time is different, it's impossible not to notice what gold has done this time, which things are different, and the things that it has never done before. First, Thursday, it had its highest monthly close ever, which was comfortably in the $2,000 price range. Secondly, it had its highest weekly close, and if that wasn't enough, Friday it hit its all-time daily high of $2,071. Making things even more bullish was the fact that on the back of all of this, gold had tried to break through this level 3 other times of making these new highs. And if that wasn't good enough for you, it's not like gold did this on the back of some random or black swan event that suddenly drove the price up. Nah, gold literally had to grind this one out, and that is even more bullish, as I will explain in a moment. In a nutshell, what gold has done in the last 3 days of the market has been fundamentally, technically, and psychologically very bullish. Now, if you're new to Stackers University, please don't think I'm a perma bull and all we talk about around here is how gold and silver are going to the moon. Much of what you've heard from me over the last few years was me being short-term bearish but long-term bullish. With pretty good accuracy, we have called many of the lows over the last 18 months, which have given you and me incredible buying opportunities that have absolutely allowed us to get the most metal for our dollars. We've been able to do this because we continue to recognize and focus on the fundamentals, the technicals, and the psychological aspects of the market conditions, which is why we've been able to separate out the signals from the noise. I'm going to warn you right now, people are a little skittish and somewhat in disbelief about what has happened in the market, and I get it. However, from my vantage point, it's taken gold the last 3 years just to have this quote overnight success of the last 3 days or so. As the skittishness starts to wear off, inevitably, you're going to quickly see people coming out with all the ridiculous videos and talking about $5,000 gold and $1,500 silver, all in an attempt to get your attention. But you roll with the doc and Stackers University, which means you're not going to get caught up in that nonsense, especially when it comes to silver price. You're simply going to pull out this chart that we covered 2 videos ago, look at the gold price, and look at a reasonable gold to silver ratio and determine what a realistic expectation for silver is. Remember, the noise will be all the hype and excitement around gold being in an uncharted territory, conversations about how high gold can really go, and all the stuff that are about getting your clicks. But no, the signals, which are about the data, the facts, and the figures, that's what we're going to focus on. Remember, we focus on the signals while we're trying to ignore as much of the noise as we can. With that out of the way, let's jump to my top 5 reasons why gold prices will increase quickly, which includes technical, fundamental, and psychological indicators. First, market technicals. There are so many good things to mention here. Should we start with the fact that gold price had a perfect 50% ABC correction, or should we talk about the incredibly low levels of open interest on the COMEX, or that total gold ETFs are far from their highs, or that 71% of money managers hold 0 to 1% exposure to the gold price? All incredibly bullish indicators, because that means it's going to shift in the other direction. How about we talk about momentum for the moment? I'm going to try not to nerd out here on you with a physics lesson, but momentum is extremely important. Just ask Michael Oliver. While it sounds really simple to define momentum as mass times, but as an investor, momentum is a critically important indicator because the greater the momentum, the harder it is to stop the movement. This is why we look at technical indicators like the oscillators and moving averages shown here in this chart. As it relates to right now, what is really encouraging is that while the RSI and the stochastic are just starting to touch at overbought levels or overbought territory, they really aren't at levels that would suggest a price pullback is right in front of us, at least in the short term. As you can see, as a part of this momentum formula is mass, meaning how much weight is moving at a certain velocity. And this leads to the next bullish indicator gold gave us this week, specifically the way mining stocks joined the rally, something we haven't seen in forever. Just last week, we saw the GDX not just move up with gold price, it exceeded the gains in the gold price. While gold was up 2.5%, GDX went up 7% last week. This means that we are starting to see money rotate into the sector. As a quick aside, this is exactly why I keep talking to you about mining stock. In a bull market, the percent increases in the metal is nothing compared to the leverage growth that you can experience with the equities. Here's an analogy for you. Your physical metals are like the foundation of your financial home, but your equities, your mining stocks, they determine the type of home you build on that foundation. Your mining stocks and equities are how you grow your wealth, and metals are how you store and preserve your wealth. A few videos ago, I mentioned a series of reports that are coming out from the Wealth Research Group and Leo Gantz. The second report just released, and there are some interesting charts and data related to why mining stocks are poised to be a great investment. You can find that link in my description. As creators, we're always asking for a like, a comment, or a subscription. But this time, I want to ask you for a favor. I would really appreciate it if you would take a moment and click on the link and check out the report. Not just for the value of the report, but also as a way to support this channel. I hope you can tell that I put a lot of effort into my videos, content, and I'm not just out here shooting from the hip. I don't do this for views, I do it for the love of teaching and sharing information. I take this craft very seriously, and I don't try to sell you anything or try to make money off of you. I do this for the love. My ask of you right now is that you do me a favor and go into the description, click on the link, and download the report. It's completely free to you, and I don't get money for you clicking on the link. As a small channel, you clicking on the link helps me because it sends a message to Leor and other professionals in the industry that this is a channel they should pay attention to, which will give me more opportunities to bring on and interview people like Leor, Keith Weiner, and experts so that we can continue to learn from them. Thank you for just considering this request, and more importantly, thanks for being amazing viewers and all the amazing comments. Okay, let's get back to the content. Next, let's talk about fundamentals, specifically interest rates. While the Fed hasn't lowered rates, which we all know would be like pouring gasoline on gold and silver prices, the rate hikes are over, and we all know that gold rises when yields fall. This is because when we talk about real interest rates, which subtracts out the inflation rate. As a quick aside, many people simply talk to you about interest rates being the key, and that just isn't factual. When you run a correlation between interest rates and gold prices, the coefficient is like negative 0.16, which means they are not connected. Only 16% of the time do they work together. That means 84% of the time something else is going on and they have nothing to do with each other. Instead, I want you to look at these two tables, which show you that the current real interest rate is negative 1%. And this is important because of the next chart, which is from Jeffrey Christian and the CPM group. Again, another quick aside. I keep telling y'all that you need to ignore all the noise and the nonsense. People talk about him on Reddit and all the other places. This dude knows what he's talking about. He brings the receipts to prove it. And frankly, he makes a ton of money selling the data and information to the industry. He gets paid to get it right, and that's all I care about. Enough of what feels like me cheerleading for him. This chart from CPM shows the relationship between real interest rates and the median monthly return of gold based on real interest rates. This chart tells us that we should expect prices to increase monthly as long as real interest rates remain below 1%. And as I shared right now, they are at a negative 1%, which leads me to the next point. Third, inflation is here to stay. Let's talk about inflation in terms of something most of us can relate to: weight loss. Whenever you start your first start a diet, the first 10 to 20 pounds are the easiest to get off, but the last 5 are the hardest to lose. This is what the Fed is dealing with right now. They were able to get the easy way off, but getting inflation from 3% to 2% is a totally different story. Not to mention, inflation tends to come in waves, so we should fully expect another round of inflation, which means an even more negative real interest rate environment for gold. Remember those old Bo Jackson commercials, Bo knows? Well, let me tell you who also knows. Gold knows. People often talk about gold sniffing out things and moving in advance of an actual indicator verifying what's happening in the market. I'm going to suggest to you that gold knows that another wave of inflation is coming. Gold knows that fundamentally the economy is in trouble. And gold knows that the Fed on average cuts rates 6 months after they stop raising the rates. We also see confirmation of this from the University of Michigan Consumer Sentiment Survey, where the median 12-month inflation expectations rose from 4.2% to 4.5% and are at the highest level since April. On top of that, the 5-year expectations rose from 3% to 3.2%, the highest since 2011. Number 4, seasonality matters. I'm sure most of you have seen this chart or something similar, but all real traders and investors know that there is a seasonality to gold and silver prices. You might hear some other people like Vince Lancer refer to this as buying season. Regardless, take a look at this chart and what do we see? Something we all should know by now. November through February are 4 of the months where we have the highest returns on gold. Again, another very bullish sentiment for the metals. Number 5, and maybe one of the more powerful forces when it comes to metals market, is human psychology and sentiment. We talked about this all the time, but most people just focus on price, and that is what drives their investment decisions. It's amazing how many people will not buy something when the price has fallen through the floor. Just watch the number of people who will start buying gold now at $2,100 that wouldn't have touched it 2 months ago when it was only $1,800. We often talk about fear and greed around here, and nothing drives the gold price like fear. The fear can be as significant as geopolitically based, which is what we've seen over the last few years, or as simple as fear of missing out. That is another key indicator. The FOMO will start to kick in. These new all-time highs for gold are going to drive many more people into gold because of simple human psychology. Don't get me wrong, there are a number of other reasons we could come up with to support our thesis that prices are set to move higher quickly, but these are my top 5. Do not think for a moment that I'm saying prices will go straight up. In fact, I don't even think we want to see that happen. Remember, Elliott wave theory and Fibonacci retracements. That's how healthy markets move. And that's what we want to see in the price movement, as those retracements will become our buying opportunities. Regardless of how short and long-term bullish I am right now, please don't forget, our sentiment has to change when the data and indicators change. This is what drives our decision-making and our outlook. In the comment section, give me one other reason why you believe prices will go higher, or why you may think they may fall. Which of the 5 indicators that I shared do you find most compelling? Or simply put an A+ in the comments to let everyone know that you always stack smarter and never stop learning.